Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show, recording in our 10th year of podcasting, which is absolutely bonkers. It just gives me a sense for how old I'm getting and how mediocre my career in property investment has been over the last sort of 2 decades that I've nearly been investing. Should have been doing a lot more than what I have done. I feel like I've been left behind, but that's okay. I'll remedy that at some point in time. The good thing about property is that it's always the right time to enter the market. And I think the market that we are moving into will be shaped certainly by what just happened over the weekend with the federal election. Already I'm seeing a lot of people talking about the issues you're going to have with potentially taxing unrealised gains in super funds, how that's going to shape property price. The fact that you can, as a first-time buyers with a 5% down, get into the market on inverted commas the average. I think the number for investing in Sydney is going to be about $1.5 million. So the talk and the economists are saying that's going to put upwards pressure on prices. So we'll see how that plays out. We're going to get stuck into it over the course of this year, breaking apart what the election means and what you can do about it and how you can take action around it. But largely our cohort of listeners are property investors. So we talk about strategies and applications of that so you can realise how you can go about investing in property and create some dough doing that. Obviously, lending is absolutely critical to that. That's the reason why I bring Eva Loisance from Finni Mortgages on a couple of times a month to chat through borrowing, what's going on and how you can be smarter about it. But today we have a guest joining her, Sam Gordon. You may know him. He's from the School of Property. He's also very familiar for a lot of you from Australian Property Scout. So we're going to pull apart lending, the biggest mistakes that people make, investors make, with a lens towards what do you do about it as you build your portfolio. Team, how's it going?
Great.
Eva, good to see you. So we're going to do this a couple of times this year, come together as a team.
Yep. I believe so,
work
mate.
it through.
Yeah, pumped to do it, man.
Which is cool. So Finni and the School of Property sort of, you appear on School of Property videos, Eva, you provide education to the School of Property cohort, from what I understand. Is that right?
Yeah, I think we're on the same mission.
The same mission? What's that?
Same mission to get people onto the property ladder,
Yep.
get them to build wealth, generational wealth. Yeah.
That's it. And remind me what the School of Property is, Sam.
Sorry, mate?
Remind me what the School of Property is.
So School of Property, mate, is pretty much my whole catalogue of everything that's in this brain, effectively from 15 plus years of investing and building quite a large portfolio as well. So, yeah, man, there's so many different sort of levels and strategies that are within it. And Eva's obviously the broker partner that we have within it, Eva and Finni. So it's awesome. You know, unpacked a lot of different things. We have great feedback around the lessons and learnings that are within it as well, going across multiple different topics within it from a lending perspective.
So it's like a training course that you buy, is it?
Yeah, for sure. Yeah, so it's effectively like an online learning platform, and it's when I started it, which was late 2023, December 2023. I had about 70 odd lessons and I think it was about 80, 90 hours. Now it's up to about 110 lessons, and well over 100 hours of lessons and learnings. And made to do a monthly webinar on there as well. It goes for about 2 to 3 hours, just running through all the students' questions. And then we have the once a year or twice a year boot camp and summit that comes off the back of it as well. So.
Yeah, well, I see, and you hold that at the Star, I think, don't you? Yeah, which is pretty cool. Have you done one in Brizzy yet, or
we did
the Goldie?
Yeah, we did the Goldie.
Yeah.
It was about this time last year. We did the Goldie.
Yeah.
That was the first one. We had about 500 people to that one, and then we did the Star at the end of last year. And that was awesome. That was around the same time as that infamous yacht party, Christmas party that we had as well.
That's right.
That was the day after.
Yeah, you've been you've avoided being in the paper recently. I haven't seen you.
Yeah, that one came pretty good at me.
Leave that one alone.
But that was 700. That was 700 people at that one, mate. So that was awesome. That was really cool.
What I like about sort of upskilling, right? And there's a whole bunch of ways you can do it. You know, now there's a whole bunch of podcasts. We've been doing this for years. You've got your podcast. There's a whole bunch of other ones. There's sort of training education courses, but there's this mantra I hear quite a lot, and I quite like it, and I'll use it often in business. I didn't like the lesson, but it was a good lesson, which is this idea of like, you know, lessons sometimes are hard, and they're not always, you know, beneficial for you, other than maybe changing and shaping the way in which you do stuff in the future. So I didn't like the lesson, but it was a good lesson. No doubt that's very much a lot of the stuff you talk about in School of Property is that, hey, these are the mistakes that people make all the time.
Yeah.
They're not nice lessons, but they're good lessons because they can determine what you do in the future.
Mate, I've had people that have been 10, 20 plus year investors that have been investing for literally for that period of time, 5, 10 years, 20 years, 10, 20 plus property portfolios that they watch it and they just have light bulb moments. They blow up my phone and go, oh, mate, I didn't know this, didn't know this, didn't know this. And things that can really like change the trajectory of a portfolio as well. And I think that's a big thing is that there's so many learnings and lessons that you can make. And one of my favorite sayings is a loss is only a loss if you don't learn from it.
Yeah.
If you learn from it, it's a lesson. And it might have a certain price tag on it, and that price tag might be expensive and it might be brutal. But mate, so often, the lessons that we take from mistakes and losses during this piece are what builds us and builds us forward. So
yeah, and I guess the mission I've been on over the last 10 years is to try and help people not make the mistakes that other people have made before them, right?
For sure.
And I think largely there's a cohort of people that act and operate within property investment who take that on, particularly buyers agents, property strategists, mortgage brokers, right? It's easy to avoid a lot of the mistakes as long as you've got, someone to help guide you through it, Eva.
Yeah. And I hear that all the time. People are like, oh, I'm sick of hearing about the right team around you, blah, blah, blah. But it's essential.
it's crazy. It's everything.
It's everything. So it's like if you don't have the good accountant, the good buyer's agent, and a
Great
broker to align to what you're doing and telling you the right thing, it can go. Yeah, and I guess that's why people get stuck after 2 properties mostly.
Yeah, and they do. Well, now
It's one of those things as well. You don't know what you don't know. And if you're trying to wing it yourself or even like listen to podcasts and all the rest of the stuff, you can learn a lot, but ultimately you need someone that's been there and done it before and super experienced
and
with
it's
it.
not based to your circumstances specifically. So
sure.
the advice might not be right for you, even if it's the mainstream advice that's going.
Well, one of the
yeah.
issues is that there's so much information out there, it's easy to learn
get
from
lost.
other people's mistakes, but you still need to take action. So today, what we're going to do is chat about the common mistakes in lending, and this we'll do the 10 most common mistakes in lending because it's a nice catchy headline, and no doubt it gets splashed all over social media. The first one. So what we'll do, if you can give me a mortgage interpretation of it, Eva, and then Sam, if you can give me a tactical or strategic property buying interpretation of it.
No worries.
And then I think that's probably a good way for us to go. So Eva, the first one here is not understanding tax deductibility of interest if debt is for investment.
Yeah, that's a big one.
Yeah.
Huge one. And I think that comes from just people not knowing that an investment debt is tax deductible, whether that debt is coming from your home or coming from an investment property. So if you structure your loan in a way that's incorrect, or you're not getting, you might be getting, cash out of your offset, that's non-tax deductible, and it doesn't help you to further increase your borrowing capacity. If you do a new split for investment purpose, it's tax deductible. You would get more tax deductibility. You can borrow more money and keep going. So there's a huge thing about it where people just think, oh, I just get cash in my offset. I'm just going to use this. I'm just going to cross my properties and not really realize what part of the debt is for investment or for my home. It's got a huge impact on how much they would be able to borrow in the future, how much tax they can get back.
Okay, so is this an accountant thing or is this a broker thing?
It is an accountant thing, but the broker has to structure it properly. Otherwise, your accountant can't tax deduct what's for the investment. They wouldn't even know what's for what.
So often the accountant will lead the borrowing aspect of it, and if the accountant doesn't know, that means the investor's going to be...
I'm hoping accountant would know
a lot of the times, maybe...
Oh my God, I would hope they do.
I'd hope so. Sam, what's your view of this, mate, around tax deductibility of mortgages when you're buying?
Yeah, for sure. Exactly as Eva says there. There's so many people that structure it incorrectly. They might just do, just leverage the loan up, but keep it as one big loan and not have the clear splits, between what is being carved off for investment and what's the primary residence debt as well. I think it's a lot of people that don't understand that it's actually possible too, that you can actually split it up, have it separate, and utilize that equity that's within your own home. Because so often, so many Australians, all their wealth's tied up in their primary residence. They get on the bandwagon, they get excited about investing, but then they're worried about leveraging their loan up and having that additional cost that a lot of people don't realize actually is tax deductible as well.
So I'm simple. So say if you've got 500 grand of equity in your principal as residence and you pull out 200 grand of that for the purpose of investing in property, that becomes tax deductible. But you still keep your family home. So you're leveraging all the benefits of increasing the equity in your family home. You're deploying it elsewhere and you're getting the tax deductibility.
Yeah, for sure.
Yeah. Okay. All right. Speak to your accountant, speak to your broker. That's pretty basic 101 stuff, right?
Yeah, that's basic, but it's
overlooked by so many people.
Mistake number one.
And gotten wrong by so many accountants as well. Because it's funny, because like
Accountants get it wrong.
Exactly. You think it would be like common knowledge, but there's so many accountants that they're just really, like pencil pushers in a way. And you got to make, again, as Eva said before, it's a team, the correct team around you that'll give you the right advice to structure it properly as well. So that definitely is the accountant question, but it's the execution by the broker.
Again, execution is absolutely critical. So the second thing, and this is more maybe a philosophical thing, but there is certainly an application of it when it comes to growing a portfolio. Either buying a principal place of residence and not rent investing. I've been on the record. I don't like the term rent investing. I think it's an idiot term. This is pretty much.
I love the term.
Do you like the term rent investing?
Yeah,
I do
think,
too.
I think it's exactly what it
This
is.
is 2v1, mate. You're gone.
I think it's a
Do you like
stupid
it
term.
too?
Yeah, I love it.
I don't know who invented it. Maybe I invented it. I don't know. I can't remember. But it's just like, it's just being a property investor and renting where you want to live.
Yes, that's perfect. And actually goes back to point number one, where let's say you want to go and buy your home. It's non-tax deductible. It's a home. You can only borrow, let's say, 500,000. If you change your strategy and say, well, you know what, I'm just going to rent somewhere and buy an investment property, that whole debt becomes tax deductible. You're getting rent as well. Your capacity might go to 650, 700. Can do so much more.
But this is a philosophical thing, and it's a cultural thing, and it's a historic thing, and Australians should buy their home and live in it and raise a family, Sam.
Yeah, and they can.
That's what you do, isn't it?
Man, I mean, it's funny because I started as I never rented. So I bought my first home at 19 and I lived in my own primary residences until I was 27, and I hit a ceiling with lending. And I was shown, by my broker at the time how to keep moving forward. And I effectively rented that out and then went and rented something else. And my capacity increased and I was able to keep moving forward. And I think this is the thing, mate. It's an old adage in Australia that you got to buy your own home. And so many people have the pressure from their parents to do it, or all their friends are going and doing it. And bucking the trend and going against that is, like, so if you go down that sheep path, you follow the herd, you're going to get the herd result. Whereas sometimes you've got to change tactic and do something else like this. And exactly as Eva's saying, that the borrowing capacity changes so much. It's pure, tax deductible debt. Your serviceability is increased because you're renting something that's, especially right now with where interest rates are, significantly cheaper to rent than it is to own. So there's just so many reasons why this works so well. And I've got a massive portfolio and I still rent. You know what I mean? Like,
do you think you'll always rent? Do you reckon you'll always be a renter? Yeah, things might change eventually.
Maybe when I settle down in terms of like having a family and kind of lock in, but I've done the work from a portfolio side that's afforded me the ability to do it. Yeah. And I think so many people, they get stuck with lending, and sometimes it can be the lever that they pull. And we've had so many clients that have literally sold the primary residence and gone back to renting, even though they've got a family, because it really like supercharges the portfolio growth. So it's one of those things. And so many people have so much cash tied up in it. Let's say it's a $2 million home or $1 million home with $500 or $1 million worth of debt. But if they pulled that, million up to $1.5 million of primary residence non-tax deductible debt, it doesn't help their situation. If anything, it handicaps them.
It's a massive mindset shift. So to Sam's point, you can go back to this, right? There's no reason why you can't sell the principal place of residence.
Yeah, or rent it out.
Go all in or rent it out. Which
I think if people
and there's
saw
tax
the numbers,
consequences around that as well.
I think if people saw the numbers, that's the situation now. That's what you could do. It's black and white. So reinvesting is a great term.
We did the numbers at the summit and back in November, and mate, everyone's minds were blown because I ran through the different price points, like 500, $1 million, $2 million, $5 million primary residences, and the difference. I did a 10 mil primary residence, and like on the Gold Coast, I'm sure is beachfront home worth like 10 mil, renting for like $3,000 a week, which people might think sounds crazy, but the mortgage repayment was like $600,000 a year, or it was something crazy versus like 150 to rent it out. So like even at that sort of crazy level, but it really shifts once you start going above like $1.5 million, which in Australia is like just an average house price now. Whereas if you really want, the dream home for most people is at least 2, 3, 5 million, something like that. Yeah. If you can't buy what you really want to buy now and have your portfolio, park the primary residence, rent vest, build a big portfolio, come back for the primary residence when you're at the end of your investing journey and you can actually afford to do it. It's just like final piece in the puzzle.
Yeah, or you can trade up and buy a, which is a lot of people's exit, right? From property investment is just to buy a nice place and retire into it and with no debt on it. But there's pros and cons with some of the ways in which state governments have changed legislation around renting. No grounds evictions and allowing pets and stuff like. Yeah, it's all happening now. Which, if the common objection against rent investing is, I've got no stability for my family. What happens if we get thrown another property? Blah blah blah. It's a lot harder now. So there's a lot of benefits now in the way in which I think there's a wider sentiment that people will rent forever. There'll start being, it's still a cycle of 6 and 12 months lease. But if you're renting that $10 million property on the beachfront, you could probably do 2-3 year like deals on rents to lock in that. So it's a really good point. I think it's a good strategy. But you just got to get beyond the fact of, hey, I might get thrown out of my place at any point in time. But
I think it's just exactly as you said, it's a mindset shift. But I think exactly as Eva's saying there, run the numbers, see what you can do from an investing perspective. Even if you did it for 2, 3, 5 years to set yourself up and then come back and buy the primary residence, you change your whole trajectory of your life by building that portfolio in that time frame versus taking on that anchor now that'll hold you back from being able to do it.
Yeah. Third point here, Eva, accepting a no when you aren't actually capped out. This is when brokers really come into their own, right? There's always a way. There's always a way.
There's always a way. Look, there's, 50 lenders we have access to. Most people, they would check 3, 4. They would go to one bank. They would go to a broker that only, likes to deal with 15 banks. There's always a way. And sometimes it's just reshifting debts that wasn't structured properly. Sometimes it's closing non-tax effective debts as well, like car loans or credit cards. Sometimes it's just, let's review your rents on all your properties or get a pair or something. There's always something. And it could be servicing, it could be a valuation, it could be no equity. There's lots of ways to do it. And at least, even if it's a no for now, we might be able to say, look, you just need to switch that and move that around, and that will work in 2 months' time.
And I know you work with a lot of sort of first-time investors where they'll come to you and go, I've got this deposit and it's a no for now. However, you need to ...
Yeah.
So if it's a no for now, you can give the approach for how you can turn it into a yes in time. And then give people a goal, because sometimes people need a goal to work to, but they aren't able to actually formulate what that goal is.
If you don't know, that's right. If you don't know what you need, and you don't need much really to start, and you actually need 0 if you look at a family pledge.
There's always a way.
There's always a way.
There's always a way. You've been told quite a few times, Sam, in your investing journey.
Many times, many times.
You still get told no now?
Not so much these days. Not so much these days. But yeah, man, I did for many years. It was actually funny. It was probably at the point where I actually, when I swapped to rent vesting, that was probably the second last no, and then during COVID, that was probably my last no, which we then figured out a pathway around. But I think it's to Eva's point. It's all about having the correct. Again, we go back to the correct team. If you have a broker that's telling you no, and they don't give you like a but in this time frame, or this is what you could do, you're with the wrong broker, because you should always be with someone that's like looking for the solution. It's a solutions-based broker, thinking broker all the time, because there's always a way. And again, it might not be right now, but it's, again, if we close these credit cards, or eliminate this debt, or restructure this debt, or whatever it is, there's always ways around it. And that's what I've always found, mate. I was a low-income earner that built 20+ property portfolio in my 20s on a low PAYG income. And it's always like just finding the way to finesse your way around it and structure it and change it. And sometimes it is time, that you've got to wait for this to happen, or be able to realign your rents, or restructure this debt or that debt or whatever. But yeah, it's there's always a way forward. It may not be immediately, but it's having the right person that can show you how to do it as well over time.
So when you stopped living in your principal place of residence, did you sell it, or you turn it into an investment property?
I turned it into an investment.
Yeah. Do you still have it?
Yeah, I still do. Actually.
You're always going to have it. You're going to keep it.
I actually don't know, because the very first one I had, I've sold that. That was my first primary residence. I sold that one in the Sydney boom.
Okay.
But then the second one, which is the one that I turned into the rent vesting one, I kind of got a little lucky. That thing's like nearly quadrupled, because it doubled in the Sydney boom, and then it doubled again in the COVID boom, because it was on the outskirts of Sydney. It was in the Southern Highlands. Okay. So I kind of had that fringe flow on, because there was no lockdowns there. So it like doubled twice.
That's right.
So I don't know, but it's like I had the 6-year rule kind of by the time it had gone through massive growth. So I'm actually tossing it up at the moment to maybe.
I reckon it's not going to grow anymore.
Nah, I don't think so. Yeah. It's just that little bit of like sentiment. I lived in there for like 6-7 years.
Well, they reckon that the whole there, I think it's down sort of Barrel way by memory, right?
Yeah.
They reckon like that's just going to keep, the proximity to Sydney now, and the airport sort of access and all this sort of things. So,
I think the desirability of living down there too. It's kind of like the Gold Coast, right? Like it was dead for so long, and now it's just like still charging, still running. That was off the back of COVID, but I think it's Wollongong was the same, was dead for a long time, and it's just like it's had that continual sort of run from that lifestyle change. And I think
I went down to Gong recently, and looked at one of the places we got down there in Port Kembla.
Port Kembla, you went somewhere that one,
yeah. It's crazy. It's absolutely crazy. It's like right on the beach. It's crazy. I wouldn't, it's not the most glamorous place, but long term, that's I think Port Kembla in that area around there is going to be, a good spot. So happy to have bought that. Let's get to the fourth point, but we're going to go a quick break. Stay with us. We'll be back in a moment. Welcome back, Phil Tarrant from Smart Property Investment with Sam Gordon and Eva Loisance, Finni and School of Property inversely, respectively. Number 4, cross-securitising or cross-collateralising, which I know you love to do, Eva.
I was going to say I'm sick of talking. Don't people learn by now?
How much of it do you see?
All the time.
Let's just define what cross-securitising is.
That is when you buy a property and the loan for that property is secured not only by the property you're buying, but another one in your portfolio.
And that's in order to access the equity in the other property.
Yeah, instead of getting a cash out and separate things.
So how often is it? Like, give me a, like more often than not, or?
Yeah, we do. I don't know. With the team, we would fix one a week. We would fix.
As in fix.
As in uncross, refinance, uncross, separate things with property, because in itself, it's not a big deal. But once you do want to get cash out for the next property, once you want to sell, once you want to get pricing, once you want to get valuation, it's a real mess, and it would really slow down your progress. So if you buy one property too and you stop there, that's not a big deal.
Yeah.
But if you really take investing seriously, that can really even stop you, I'd say.
So it could you could stifle decision making, because it means that one property is incumbent on another. So if you want to do one thing with one property, it means you've got to do it with everything.
The other one's linked to everything.
And banks like
they love
crossing.
it. You can't refinance. You get it's just so hard to do anything.
Not being a cynic, but
they love it.
So if you go into a bank branch, and it doesn't matter what bank branch it is, and you go, I want to
and that's where it comes from. A lot of the time, people don't even realize, or don't even know, and I guess they just don't even think about asking. It's
so you don't know. You don't know. Or you just think it's normal. They go, this is how it works. And you go, okay,
it's easier. You only get 2 loans, and it's just
yeah. Okay. All right. You see it?
See it all the time. All the time. It's crazy.
Do you ever unravel it? Is there ever a reason to keep?
No. It's look. I think the thing is, people find it easy when they first start out. They go to the bank because I think, and the mainstream banks love it. Yeah. Because they get you in, and they can very easily just go for another one. Oh, you got a bit of equity in this. We'll just use that as a deposit, and then they kind of cross them, and then maybe you get a third one done. It's when if you're trying to build a serious portfolio, it's when you then obviously need to step to a broker for assistance. That it's like, whoa, you're seriously stuck, because everything's just sort of tied in. All your values are tied together, all your debts are tied together, and it's extremely hard to sort of, let's say if you had one standout performer growth property and the others are just stagnated, you almost always can't access the equity because they're all linked together, both the debts and the values as well. So it's just messy, and it's a trap that a lot of first timers fall into, because they get referred by a friend that, this banker at X bank helped them buy their home, and they're really easy to deal with, because banks a lot of time to start out with are really easy to deal with on a first property. But are they strategically going to get you to build a big portfolio? No, they're just trying to write a loan and get that done. So it's one of the fastest ways to getting yourself seriously stuck. And if anyone that wants to build a serious portfolio, like it stunts the growth 100%, and it takes a long time for an experienced broker to even be able to unwind it. So
is it hard to fix, or it means you've got to refinance all the loans?
Yeah, you've got to move everything.
And the lenders probably, you can't uncross a loan without refinancing. You can't go to that lender and just go, mate, there's enough equity in this. Just
you could
pull it apart.
You could do like a partial release of a property. Yeah, but if you're going to get equity out at the same time, you might as well refinance it to better.
And the cynic of me would say that if you've got a lot of cross loans with a lender, it's going to be pretty hard to negotiate on interest rates with them. If you go, well, I could get cheaper rates elsewhere, they're going to go, yeah, go on.
They would do like instead of having, say, you might have a property that has 60% LVR, but it's been crossed, so your LVR is now 80 across the board. So you're going to get a better rate.
Yeah. So the argument would be you should be able to get a sharper rate on the 60% LVR, but because it's all clubbed up together, they're going to do it at the top of the
and it would be like, we need to do a valuation on all the properties again, and you have to pay for it.
The big one we see with this a lot of the time as well is someone with the primary residence, and then they go buy an investment or two and they cross it back to the primary residence. And your biggest exposure point here is like, you don't want to sell your primary residence to, most people won't sell the primary residence to keep moving forward, and cycles go up and down. So when the cycle comes up, like, and obviously not the whole way, but you might have a correction. But if a cycle goes, up to, you have a nice point of growth, and then you use that equity as to cross over to buy another, investment number 1 or investment number 2. If that market then cools off a little bit post boom and it comes back, all of a sudden, even though your investment properties may have grown, because the values have potentially dipped a little bit on that end, you can't access it, and you're just all tied up. And even then, it might be hard to actually refinance out if the value has come back a bit on a primary residence too. And
I imagine also probably blurs things a little bit with the first point around tax deductibility with crossing properties, and like Again, that's going to be an accounting question.
Mm.
And you want to make it as simple as possible. Yeah, I've never crossed anything. You've never crossed anything. No,
Well, you'd hope not.
Fifth point here: choosing a lender based on their rates. Eva.
Yeah.
Oh, I'm shopping around mortgage brokers to see where I can get the sharpest rate. You must hear that every now and then.
No, we do, but not so much. I think people who come to us are a bit more, I guess.
Well, you guys are really
educated.
sort of investor savvy, aren't you?
Yeah. So, well, you still get that from, I guess, someone that bought their first home, and that's how that shows their owner-occupier, P&I with offset, and then they just have the same mindset for the next one, not thinking that, well, maybe the rate is just one part of it. And funny enough, the other day, I got someone on a higher interest rate just for servicing purpose, and the adoption with a lower interest rate, but getting a higher interest rate, having more tax deductibility, more negative gearing, increased the capacity.
There you go.
So we got them.
Who worked that out? Them, you, or the accountant?
Yeah, I worked that out.
That's a broker, man. Come on.
So we did this. I said, no discount. You're going to pay the high interest rate 8%. We settle it. And as soon as it's settled, we get a discount and go back to the 6 point whatever that you might get. But let's just settle you on
This is why you need a mortgage broker, isn't
on
it?
a high, ugly rate for now, just to get it done.
This is why you need the right mortgage broker.
That's why you need the right mortgage broker.
Yeah, that was a bit pushy, but
Were you happy?
got it done.
Were you happy with the solution?
It worked.
Yeah.
And you're able to get it back down after the fact?
Yeah.
Yeah, perfect. That's amazing.
Yeah. All right.
Oh, so often it's just about getting the debt, right? And
I reckon you've paid some high interest rates over the years. What's the highest you've ever paid? When you're close to no. When you're close to no.
I had that bill during COVID, and the only option was private, and I think I was at like 13%, just to settle the block of dirt because no one would settle. No, sorry, I settled the block of dirt in cash. It was to do the build. It was at like 13%. It was. Like
I reckon your project managed that build pretty tightly.
Yeah, I was trying to get that done real quick. But during COVID was a funny one. Like I had to do what I had to do to get funding, and there was crazy deals on the table, and not that many people out there. So people were getting interest rates in the 2s, and I was paying in the 6s.
Yeah.
So I was literally paying like 3 to 4% higher. But I look at the properties I bought during COVID, and I would have made like in 12 months, I would have made in terms of like what I bought those properties at that time, like $3.5–4 million off it. And like people will look at the interest rate and go, oh no, I can get things in the 2s. There's no way I'm paying 5s and 6s. But like looking at the bigger picture, I loaded up in Brisbane, and the market was so low, and we're buying at heavy discounts, and then obviously getting able to ride it. And I think this is the biggest thing. People get so fixated on a rate, even if it was at 8%, or whether it's at, I can get it at 6.5, but they won't pay 7 or 7.5 in today's environment. But it's like an extra 1% in debt for $1 million, it's an extra $10,000 a year, right? But if you can get 2 deals with that, let's say 2 deals with that, and each deal goes up $50,000 a year. The $10,000 compared to $100,000 of the 2 deals, you have a 10x return.
It's probably the one question that you can ask a property investor to work out whether or not they're a real deal property investor. Just their attitude towards interest rates, and you hear it all the time.
Yeah, no, I don't even mention interest rate.
Yeah.
People don't even ask me anymore. Like they just investors
but
just.
But
don't.
you would assume that if you're getting a reasonably standard loan, that the rate should be thereabouts standard.
Yeah, that's right. But like it's not even a
minus.
Conversation that I have like specifically, right? It's just like part of it. Oh yes, it's roughly there. It's fine, and it's fine. It's not. And I know when I used to deal with an occupier, that was like, oh, it's 0.01% higher. Oh my gosh.
Yeah. All right.
You just want access to debt, man. That's the name of the game.
Well, I guess that's connected with this 6 point here, which is leaving equity in your primary residence. That's, Sam's got to say that's just lazy money, but it's easy to extract largely.
But you still need to be able to borrow it. It's still a loan. Yeah.
So you still need serviceability needs to stack up. So if you go all in on the principal place residence and you hear this a lot, and I see it a bit like I go to my kids go to a sort of pretty fancy school, and some of the mortgages I reckon some of the parents have got there low. I reckon they went all in and maximised on really nice principal place of residences, but they're probably tapped out of investing.
You make me laugh. You're thinking you tapped out. And you go and think of your.
So I probably sit there and go beep 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 beep.
You're working it off.
You still have a car loan. You still have a credit card.
Nice guy. I still rock up in my box. So.
What do you got, the surf or something?
Yeah, no, it's which is more reliable now. I remember there was a Toyota 4Runner. I remember it broke down out the front once, and I had the bonnet up, and I was jimmying it together, and some guy goes, "You're right, yeah. It's just got an electrical problem. Fix it up."
Mate.
But the inverse of so there's one thing of like going all in. If you want to be a property investor, if you chew up all your serviceability on a principal place of residence, good luck investing. But the other side of that is that, hey, you might have done that 10 years ago and you have a heap of fat of equity in your principal place of residence. Again, it's going to be a mindset shift because people are still this doctrine of you got to pay that off, pay that off, pay that off.
I think that goes back to point one is you can get a split of your home, but that's for investment purpose, completely separate. So yes, it's secured by your home. It's an investment loan. And I think that's what people forget.
And it contributes to serviceability as well, because if you're using for investment purposes,
it's acceptable.
Lenders will take sometimes 100% of the rent, sometimes 80%. Well, what's the average they'll consider?
Yeah, 80 these days.
80. So they'll consider 80% of the income that comes in on that goes on top of servicing the debt. So you know, there's shades of serviceability changes around it. But no doubt for you and your team, that's the key thing going. Why you got all this equity doing nothing?
Yeah, and don't use the cash in your offset, just use equity.
Yeah. And this is what we see so often. People just like, I've got 100 grand saved and that's all I want to use. I don't want to touch the primary residence. And it's like, well, that's non-tax deductible. Plus, like you've got, let's say 200-300, whatever it is that we could tap or more within the primary residence. You could split it off, have it as tax deductible. You could sit the 100 grand in offset against the non-tax deductible debt and then use that to actually go out and invest. So you're going to be able to scale up a portfolio more quickly. It's going to be more tax deductible, so you can actually write more of it off. And it's just intelligent investing. And I actually used to see it so often where people are like, I don't want to touch the primary residence debt at all because we've taken all this time to pay it off. I just want to use this, 80, 100, 150, whatever it is. And sometimes you just got to, this is where the education piece becomes so important, whether it's from a BA, a mortgage broker, an accountant, whatever it is, someone experiencing it that can kind of show you why it makes so much sense to do it like that as well. Because ultimately we're in the game to win. And you don't win off buying one investment property, or paying down you can't save your way to retirement. You can't save your way, paying off the primary residence over 10, 15 years. You're not going to build a passive income stream, but over 10 to 15 years, go put 200-300 grand in the market and recycle it and build it and keep growing. That's how you retire. That's how you build wealth.
Yeah. And this idea of having your principal place of residence paid off for retirement, it's cool, and I when I'm not working anymore, I don't want to have to be servicing the place where I live. Right.
Yeah.
But there's a couple of different ways to get there. It's either sitting there and paying off a 30-year mortgage and leaving it completely alone and not pulling any equity out of it, or you go and do all this other stuff, and then at a point in time you just go, oh yeah, paid. Yeah, done.
That's what I love. I love building that into the strategy of okay, sweet. Well, let's throw a few extra bread and butters or growth properties in to go through a cycle, and then once we sell them off, we use the profits to pay down the debt on the primary residence, or it's at the back end and you're rent vesting, and then you use that to actually get yourself into the dream primary residence on the back end, and maybe it formulates part of a 5-10 year pay down strategy on the primary residence, but you built the portfolio at the same time.
And this is when you really got to work closely with your accountant around it. You're going to get taxed somewhere, right? So you can choose to play off your principal place of residence with after-tax dollars, which will take you 30 years, maybe longer, because people are doing longer loans than that. Or you build a large investment portfolio, you sell it down, and if you structure things right, you can, you can shape your tax requirements a little bit and pay it down that way. So I'd rather pay off principal place of residence with manufactured equity that I've just had to sort of service the debt on, rather than principal place. But again, it's a huge mindset.
Yeah, it's all about leverage, but leverage is what it's all about. Again, I'll reiterate: you can't save your way to retirement. No. You can't save your way to the dream lifestyle you want to have at the back end. You have to leverage. You have to invest and build something.
Point number 8 here on our 10 key reasons why, or the common mistakes in investing, Eva, is balancing portfolio cash flow and growth deals. So making sure you got, most people would like capital growth and good yielding properties. Typically, you need to choose one.
Yeah,
sometimes
you need
get
both to keep going. So typically, the first 2 properties, I find people would have maybe cash to come in with the first one, and then they need equity to keep going, or they would be stuck. So the first few, you might want to think about a growth property, one that will give you equity to keep going. While you still have the servicing, and then as you move forward, maybe to property number 3, 4, and forward, you need actually good income, good yield, or what you call them, bread and butter property to keep going, because you need the servicing then to push forward. That's what I would mainly see in clients. Like the first 2 properties have to be pretty good with growth to access equity.
They have to be growth players, because you need that equity to keep moving forward.
You would say the first 2?
Yeah, definitely. Because you need to
you would say all of them need to be growth properties, and you just got to have enough cash flow to actually service the debt so you're not compromised, right?
I think it does depend. Like I always do. I always love to do cash flow deals in growth locations because then you get the double whammy. You get the growth, and obviously you get rental growth.
And you
as
can
well.
find them.
Yeah, for sure. But
Are they everywhere or
no,
they're...
definitely not everywhere.
Okay.
It's so limited, and even in the current environment, like we've changed. You always got to change tactic, especially with interest, with so many different changes that happen. Markets get to really high points and yields drop off.
Yeah.
Interest rates go super high, and that's where we've definitely made the shift in the last probably like 12 months specifically of just having that heavy focus initially on the growth, without a doubt, because so many clients, they need that growth to get into the next one or the next. Let's say the first 2 to 3 deals, and then depending on the time frame in terms of acquisition, you might restructure and put a nice. You may sell off the first one in a 2-3 year window if you've had a significant growth. Position that into something like a cash flow deal, but then be able to tap the equity in 2 and 3 to keep building it as well. So it's being strategic in your own situation, and incomes and the yields on the properties will make a massive difference to that. But yeah, almost always you need to start with growth, especially if you're coming in with a lower deposit or enough for 1 or 2 properties. You need to recycle it. You need to build the foundations first.
So we're just launching the 2026 Fast 50 report that's coming out this week, of which you contributed, participated in, which is really cool. We don't actually say what properties, which locations you recommend.
Okay.
It's a
fugazi.
It's a fugazi. It's an aggregate. But what it is, we've spoken to the leaders right across your industry, like yourself, Sam, to say, where do you reckon?
Yeah.
Where do you reckon? Where's your 20 top locations for the best capital growth in 2026? And then what we do is say, if Sam says this, and this person says this, and this person says this, and this person says this, if everyone says the same thing, you go, okay,
might be worth listening.
There's something in that, right?
Yeah.
And we don't question why you've recommended that. We've just gone, you tell us what's going to get the best capital growth in 2026, and your view of things will be different from other views of things. But we look for commonalities, like a Trivago of everything, and go, all these great minds come together, and here's the list. So that's out.
Yeah, that's cool.
It's coming out
Awesome.
This week. So I highly encourage everyone to get into that, and we've pretty much picked it. Every time we've done this report, we get it right. So this is the fastest, where to put your money today for the best capital growth in 2026. So get stuck into it. Okay, we've got 2 more points here. Let's go to another break. Stay with us, back in a moment. Welcome back. Phil Tarrant, Smart Property Investment with Sam Gordon, School of Property and Australian Property Scout, and Eva Loisance from Finni Mortgages. Now, Eva, not reassessing your position regularly. Set and forget.
No.
Madness, bonkers. You never know.
Things change all the time. I don't know how many emails I get a week on banks' policies, servicing threshold, rental income, 80-90% different. Yeah, it could be that it was so tight and you got to know, and it might be, well, actually you can go ahead now. So
there's a lender that's come out that might have a policy which now suits your situation.
That works. Yeah.
So you must like it where you can call someone up and go, I know we said no 4 months ago, but I think we've got a yes here now.
Yeah, and look, with my clients, I save my calculations, and then they just come in and say, oh, you know what, I just got a 2K fair house, does that work? And sometimes, just put it in, it works. Or on my rental, I've gone up by $10 here, $20 there, and it takes 5 minutes to check, right? Or it could be, with SMSF at the moment, we see so many changes. Like the banks lenders are so competitive to get some share of the market. It's when I told no to someone,
coming back, are they? Because coming back to the election, they're trying to potentially going to start taxing unrealised gains in super funds at $3 million, not index. That the Greens are pushing for it to be $2 million. What the Greens are also pushing is that they stop lenders borrowing inside of self-managed super funds. That's one of the ideas getting thrown around right now.
Let's get more and more people on the pension, so Australia can
makes
really
sense, right?
Yeah, it makes heaps of sense.
Makes, and I just sit there, I just bang my head against the wall.
Let's just tax everyone that's trying to actually self-retire. Amazing strategy.
I was ranting about this the other week, just going, isn't it great if Australia can manufacture self-funded retirees?
100%.
Great for the nation.
100%.
They tax you every step of the way. Yeah. But stopping lending inside of self-managed super funds. Anyway, so all the lenders are probably getting in there now before. I can't see that happening. I can't see that happening. But
there's been such an aggressive push, as Eva said there, with so many things sort of changing as well. And even as Eva was saying, there are some changes of people becoming really aggressive, even with LVRs, restrictions changing and liquidity tests changing, and it's so many changes always. It's such a fluid market, the finance and the lending arm. You have to be all over it. And even the point that I made before of like, we used to bring cash flow deals in earlier, but they're harder to get now at certain price points and in certain markets. So we've pivoted towards, let's build out more growth first, and we'll build the strategy towards this, and then potentially sell off number one to then roll into something like a potential commercial at potentially properties 3 or 4 or something like that. And I think this is where a lot of people get it wrong. They just they have one thing in their mind, and
you have to adapt and change based on
100%.
So you'd always be reassessing your portfolio or other people's portfolio.
Always, yeah.
And what I'm hearing there is that it's okay to sell, right? A lot of people say never sell.
Sure.
Don't do
Man,
it.
I'm going to sell about 15, 20 properties this year. I'm going through, I've got that many properties appraised at the moment.
See, I'm sure the government will be happy with all the tax you're going to pay on that,
100%,
right?
beautiful. And I'm going to be happy too. I don't care.
No one ever talks about this.
Mate, if you're paying tax, it means you're making money. Like, I don't care. Like, if I pay a couple of mil this year in capital gains tax, imagine how many mil I've made in terms of actual gains as well, like profited gains. So it's a good thing, man. People are scared of these different things. We're in property to make money, right? We're in property to actually profit. And so to be scared of something like a capital gains tax event, it's like, what are we owning it for? You can't eat equity. You know, you can't buy something with like in reality without like you can't just keep leveraging. So it's got to formulate part of the strategy.
Yeah, it does. And to the point, right? You've got to have an attitude. If you're making money in property, you've got to pay tax somewhere along the way, right? Yep. And I was looking at this last night, and again, property investors never get thanked for selling properties and paying capital gains tax. Property investors never get thanked for buying properties and paying stamp duty. Property investors never get thanked for paying land tax. I'd hate to know your land tax bill, right? And do you pay your land tax in one hit, or do you?
Yeah, I was paid annually.
You paid annually in one hit.
I got hammered in an article. Like it was one little comment that I made in this news report, and it was like, property investor with X amount of properties says tenants should thank their landlords. And I got absolutely hammered.
Yeah,
but
I can imagine why they had a crack. But what I'm saying that
I know. What
I'm saying is that property investors are demonized, right?
Yeah, of course.
Yeah, but geez, we provide a lot of money into the
100%.
tax system. Right?
But we also provide housing for people who can't afford to buy their own house. Like not everyone can just go straight out of mum and dad's, or they, migrants coming into the country and everything as well. Like people need places to rent. Like it's all part of it, man. Like everyone's, in their part of their journey where they are. And like, if there was no rentals available, like, can you imagine how many homeless people there'd be? Like, it's crazy.
It'd be crazy, right? And just going back to the election really quickly.
Gets injected
I don't know if you know this. So all these ideas and policies need to be paid for, right?
Here we go.
Property investors pay for a lot of this stuff, right? And the taxes that they pay. Now, one side of the coin is saying, well, you get a 50% discount on capital gains tax. That shouldn't be that way. Or you get the benefits of negative gearing, and therefore your, certain language is inflammatory around it, like stealing from whatever, right? Australians with HEX debts are about to get 20% of their debt wiped out, just gone.
Really?
Right? Yeah. Okay. It's one of the reasons why, there's such a landslide, towards whatever. So like all these people with HEX debts, of which there's heaps, right? Like, in New South Wales alone, it's 883,000 people with a HEX debt. In Victoria, there's 805,000. In Queensland, 607,000. WA, 264,000. South Australia, 201,000, etc. With HEX debts, right?
2.5 million people.
So all of these people are getting 20% shaved off. So the outstanding debt, right? So
here we go.
In New South Wales, right? In New South Wales, I saw this last night and I just went, don't talk about this.
Yeah.
And look, all these people get 20%. Happy days, right? Happy day. Good on you, right? Okay, 883,000 people owe in HEX $25 billion.
Wow.
$25 billion is owed by people with HEX in New South Wales. In New South Wales, right?
Yeah.
It's absolutely crazy, right? So these are the people going, housing affordability. This is where the rubber hits the road, right? Like, that's a big amount of money people have got to pay back before they can get going. You take 20% of that, $5 billion gone. So the government's got to find $5 billion to pay the 883,000 people their 20% of it, right?
We just discussed that outside, actually.
Yeah.
Until you actually pay off completely your HEX debt, makes no difference.
I know.
You have $1 left on it, and it'll still impact your
this
servicing.
is completely useless.
Yeah, I know. So that means on average, everyone's getting about $5,703 in New South Wales back on their HEX, right? But the point is, they've got to find that money from somewhere, and a lot of it comes from property investors and people within the property economy.
Yeah.
Anyway, so that's my rant for the day. But it's a big number.
Yeah.
A huge number.
Yeah.
$5 billion.
You are right, but property investors get massively demonized, but it's so much that gets added into the economy from property investors across so many different facets of industry that relate to it. So it's a massive driver of the economy.
And it's shifting sands as well. Like when interest rates are higher, yes, there's probably more negative gearing. When interest rates are lower, remember also, like, a lot of Australians own their home outright. The third, right? Third rent.
Yeah.
Of that third, that rent, obviously people are negative gearing around it, right? Anyway, plenty for us to chat through. So the final point here, Eva, on the common mistakes in lending, 10 of them, not embracing LMI, saving 20% deposit. So this is this 5% thing I was chatting to before, and I need some colour around it. So this new government thing saying you borrow at 5%, the government will underwrite the 15%. I don't know yet whether or not, I need to understand whether or not the government is going to pay the LMI premium to the lender, or there's no LMI premium. The government's just saying, if this person defaults, Mr. and Mrs. Bank, you come and see me and I'll sort you out.
Actually, do not know that.
So I don't know yet. So on that basis, if all of this, that means the LMI companies have just been shafted because no one's going to be taking policies on it, right? So I need to understand the colour. I don't, if anyone knows, can they tell me, please? Because I'm looking for it. I can't find it. Anyway, can you find out?
They probably haven't figured it out yet either.
No, I'm sure they haven't. They've
probably shot that one from the
They probably have thought about
shit.
it. So they just killed LMI, right? Like, because if every... anyway.
I found that there's so many other ways to get into the property market without going into any of those
schemes,
whatever that they're doing, grant and whatever. That it's so much easier, and that could avoid LMI. But anyway, LMI is your friend. Use it, get in the market quicker. It's not that much. If it's an investment, it's tax deductible.
Yeah.
I don't know why LMI is so demonized as well. Like it's...
And maybe it's a bit more normalized. Now, you would have used it in the past.
Mate, when I was in my early to mid 20s, I was doing 95s. Like I was doing everything I could because I had so little capital. I wasn't on a big income, so I was stripping whatever I could and then buying. I remember I was doing CBA 95%, and I did like 4 properties in a year just doing that.
There's a point in time people do 103% mortgages.
Yeah,
crazy stuff.
Yeah.
You still can with a family pledge.
You can do. There you go.
But man, LMIs, it's a cost of doing business.
Yeah.
It's the same as the higher interest rate that I ran through before. Like imagine if you like that 5% scenario, me buying deals at 95%. If I'd done them at 90, I would have got 2 instead of 4.
Yeah.
If I did them at 80, I would have got 1 instead of 4.
Yeah.
And like again, you look at the growth rate of all those properties since acquisition.
And you capitalise the LMI, which means it's amortised over the life of the loan. And let's imagine the loans you're going to refinance anyway at some point.
It's just a cost of doing business.
Cost of doing business.
It's a cost of doing business. Like leverage is the name of the game. You need to embrace it. You need to have a lender, a broker, that understands this and can help you structure it correctly. That is within your means of being able to actually afford it. But 88, 90, well, whatever you're going through doing it, it can get you either 2 deals with the same, pretty close 2 deals with the same deposit, or at least get you moving even into the first deal. If the 20% took you another 12 months to save, can you imagine you got into the right market?
Yeah, there's a cost of inaction as well.
100%.
You can't save as quickly as
no chance. We'll always outpace you.
Well, lots of insights there. School of Property, no doubt, heaps more. You can find out. Just Google it. Is that the best way?
Yeah. Head up www.schoolofproperty.com.au. Book in discovery call, mate. The strategist.
Do you get to speak to you, or are you sort of you're sort of hidden in the background?
Mate, I'm doing all the recordings, all the content within it, and the webinars and everything. So I've got big Brendo over there, mate. He's a super experienced investor that runs clients through strategies on the initial session, and then see if it's a fit and we can help people.
All right, nice one. And Eva, keep up the good work. Keep doing what you're doing. You're probably helping these School of Property people out. So no doubt they're happy.
Them. I just love it. I think it's great getting people to finally get out of the.
And for those people who aren't watching this on video, who are tuning into it, like Eva, when she was talking about getting solutions, you can see she really cares about it. It's cool.
She lights up, eh? Like,
yeah.
See the passion come through.
It's really good. Really good. Well, thanks for tuning in, everyone. It's our chat around finance. So we're looking down a barrel of a interest rate announcement in about 10 days' time. So we'll be back with some context around it, what it all means, what are you going to do about it, whether or not there's going to be a cut or not. I think that the mail is yes, but how much, who knows. I bet the new government will be, well, the existing government's going to be happy if that cuts come down. They'll tell us all the reasons why that's happening, and it's good for everyone. Anyway, thanks, team. Thanks for tuning in. We'll see you again next time. Remember, smartpropertyinvestment.com.au. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.